run away from stocks to cash, so what stocks should you buy? Who are you going to call? The stockbuster himself, Roger Montgomery. How are you, Roger?
That's a very, very kind introduction. I'm not sure that I'm a stockbuster. I think the market's doing a very good job of that on its own.
But for people who want to stay in the market, we want people to say, well, these stocks still look good despite...
The time to go to cash is when the swallows are chirping and the consensus is cheery and everybody thinks the future is always going to be bright and it'll never ever have a hiccup. That's the time to actually be concerned.
October 2007 sounded a bit
well,
like
or
that.
even April this year. You know, we had only 10% of our fund invested. We had 90% cash at April this year when it peaked, and we've invested progressively more over the last few months. But we're diversifying across time and diversifying across stocks. So we're spreading out our investments because, quite frankly, as I've admitted to you many times, I don't know where the stock market's going to go. I don't claim to be able to predict the direction of the stock market in aggregate. Yeah. But what I do know is that because I don't know that, if I average out over a period of time and I only pick the companies that are high quality when they're cheap, then we'll beat the market over a long period.
In these tumultuous kinds of times, how much cash are you planning on holding as a minimum, do you think?
Oh no, we don't operate that way. So we don't say to ourselves, we will keep this much cash.
There, you could go down to
values
down to
there
30%.
will go down. Yeah, and there's Cochlear. Cochlear, since we last spoke,
yeah,
you know, had a conniption. And do you think that's affected the long-term reputation of that business? No. Do I think that it's a temporary problem being treated by the market as permanent? Yes. And we take advantage of those things.
Did you buy Cochlear?
Yeah, we bought some Cochlear and we expect to buy some more.
Okay. Now, I gave a whole list of companies.
You did. I'll go through the quality scores of some of them anyway. Yeah. And you divided the portfolio up for me in terms of industrials, materials, consumer discretionary, energy, IT, and then a list of others.
Yeah.
Okay, which would have fitted in some of these. So if we start at, we'll go through the qualities. So there was Monadelphous, and I'll list these. Fleetwood.
Are these going to be A1s?
These are the A1s. I'm starting with the A1s.
So
I'm going through the list.
Fleetwood.
Monadelphous and Fleetwood are both A1s. Bradken and Iress, both A1s. Now, I noticed there was a question mark over... Was that you that put in sell on that?
No, the person who's doing the first run...
They're considering selling these stocks. Okay, so Fleetwood...
When I saw that and I knew your view on Fleetwood, I said, we've got to get Montgomery to have a good look.
Well, I don't think it's particularly cheap at the moment. No. It's not compelling value, but it is a very high-quality business.
There's a long-term investor.
It is a very high-quality company, provided they've got cash on the side to buy more of a company like Fleetwood. Well, if it does sell off, if they do the market does throw the baby out with the bathwater, then you might buy more.
It's not a bad dividend company as well.
No, in fact, it was a darn good dividend paying company when during the GFC its shares dropped to about $3.20. And I remember purchasing some shares at about $3.50 and $4, which was on a yield of something like 27% fully franked.
Christmas.
Well, yes, but somebody sold those shares to me.
Yeah.
So somebody didn't think it was Christmas. Bradken and Iress, both A1s. And then in the lower list here, Mineral Resources is another one, a mining services company, and that's an A1 as well. Yeah. Okay, so then we'll go through the other A companies. So we've got Oz Minerals as an A2, and we've got Webjet and Forge, both A2s. So that group of companies out of that portfolio, I would set them aside and say, you know, these are the David Bessows of the world. These are the businesses where management have integrity. You know, they're great. They've got great prospects.
Quality
great quality businesses. Okay. They're different to the others.
Yeah. So your A1s and A2s, you don't sell them easily.
No. And if you get the opportunity, and if you get the opportunity to work with those managers, and if you get the opportunity to buy those businesses, you do that. Okay. You know, you absolutely buy, and they're your biggest weighting in your portfolio, these types of quality. So next the Bs, Ausdrill, B3, but expensive. Boart Longyear, that's an A3, so it's right on the cusp of, you know, what we'd like. Expensive as well. Monadelphous, which I mentioned earlier, A1, but expensive. UGL. Your client is proposing to sell UGL. Well, we've got that, and I didn't mention it a second ago, we've got that as an A2, but it's expensive. So bear that in mind. Fortescue, B2.
Now, how do you rate a B2? Is a B2 a company?
Let me take you through the rankings. So A1, A2, this is in order of preference. A1, A2, B1, B2, A3, B3. That's,
okay, good.
That's investment grade.
Good reminder.
Everything, think of Standard & Poor's or Moody's or whatever, they're our investment ratings. Anything with a 4 or a 5 is not investment grade, and anything with a C is not investment grade. So A4, A5, not investment grade, B4, B5, so on and so forth. Okay. We've got BlueScope Steel, expensive, B4. Incitec Pivot, very expensive, B2. Mirabela Nickel, C4, not investment grade. Myer, interesting, pretty much on its intrinsic value now, but I don't think the analysts have ever operated a retail business who are covering it, and therefore don't know how tough it just might become for particularly for a middle of the road. You know, they're not at the high luxury end, they're not at the cheap and cheerful end. They're right in the middle. It's a really tough business to be in. Department stores are doing it tough. And we talked earlier about the perfect storm that retail is in. That's usually the time to be buying stocks when everybody thinks the end of the world is nigh.
Well, what's your DJ's? Is it B3 as well? Or B2?
No, DJ's actually an A3.
Okay.
A3.
Okay.
Okay, so Fleetwood A1, but a little bit expensive. We've talked about that. Santos C3. Not investment grade. Oil Search B3 and expensive. Reckon and Iress I mentioned earlier, A1s, but they are expensive still, despite
it's a darling of the market.
Despite the sell-off in the market. Roc Oil C3, not investment grade. Galaxy Resources C5, not investment grade. McMillan Shakespeare A4, starting to look interesting in terms of value. Clean Seas Tuna A4, so not investment grade. Mineral Resources we've talked about A1. Forge is cheap and an A2. In fact, out of the entire portfolio, Forge is the standout one as being good quality and cheap. Yep. And Webjet A2, but a bit expensive at the moment.
Great. So tell us what you would do in terms of a portfolio construction.
So what I would do is I would rank these in terms of quality, and I'd probably get rid of the last quartile of quality. So I'd divide them into 4 groups, and the last, you could use 5 groups if you wanted to be more conservative, and then that last group, I would probably get rid of those. That's what I'd be doing if I'd inherited this portfolio from someone in my family. And then the next thing I would do is the remaining stocks, I would rank them by those that are cheap and by margin of safety. And those that are the most expensive, so having removed the worst quality, though the remaining that are the most expensive, I'd probably get rid of those as well. Now, some people watching the program would say, well, Roger, if you're really true to label, if you're really going to stick to quality, then you'd get everything that isn't investment grade and sell all of those. Is if I was going to be a lot harder, just stick to the investment grade stocks, rank them by margin of safety, keep the ones that were relatively the cheapest, and the rest of them I'd have cash.
Okay, let's take 2 interesting ones. Both Monadelphous and Fleetwood are A1 or A2, aren't they?
Very high quality and a little bit expensive at the moment.
But the margin of safety is not great.
Yeah, Fleetwood I know is a couple of dollars over its intrinsic value, and I'd like to see it well below $8. Before I think that was actually cheap. Fleetwood, so Fleetwood's okay. Monadelphous is trading at a negative margin of safety of about 16%. So it's trading 16% above its intrinsic value at the moment. Now that intrinsic value is currently forecast, to give you some idea, it's currently $16.14. The stock's trading at about $19 or thereabouts. And that value currently is forecast to rise to about $21 in 2 years' time. And if you don't expect a recession globally, well, that might be right. But if you do expect a recession globally and you do expect that demand for their services are going to slow, and look at the stocks that were sold off the most, materials today and mining stocks. So the expectation is that demand for the sorts of services that Monadelphous is providing may slow down. And if it does, well, those intrinsic values will fall as well.
But of course, if someone is a long-term investor and is happy with the dividends, holding a company of this calibre is not too risky.
And that's why I said to you, first thing, go through the portfolio, get rid of the junk, and then with the remainder, look for those that are relatively 16% negative, so 16% premium to intrinsic value, may turn out to be one of the cheapest stocks in the portfolio. So it may be one that you actually have no problems with and you hang on to.
And also depends on what price they bought it as well. Mate, fantastic as always. Thanks for helping out, Roger.
Appreciate that.